Good morning, everybody. We have a lot to get to, so let's get to it. So, over the last 4 weeks, all we talked about was gold. Let's shift gears. Let's talk about stocks. And a lot of you out there still own stocks. I understand that. You've got it in your 401k plans, or you've diversified and said, I understand Zanetti and Walt's, philosophy, but I want to hedge my bets. I'd like you to consider these three charts about whether or not you want to stay in the stock market right now. So it's about a year ago, I introduced you to this chart, and it's from Hussman Analytics. And basically, what John came out and said was, look, based on our metrics, this stock market has now exceeded 1929 levels. Well, the 1929 stock market fell 89%. That was pretty devastating. Now, who's Hussman? For those of you who probably don't remember this from a year ago, Hussman's a smart guy. What he's done is years and years worth of backward testing. What variables really match up with, is a market overvalued or undervalued? Because it's all not just always PE ratios or price to sales, the stuff we usually think of. It's more nuanced and more complicated than that. His models have been pretty accurate, but a year ago, he went public. Usually you have to pay for this stuff. And this was one of the charts, back to it again. And he said, look, this market is really overvalued. But he also said this. He said, I believe the stock market's going to go higher. He said, maybe another 10, 15%. And he said, based on this, and this, we can see it rising more. A year later, how has it played out? Almost exactly right. Here we are 1 year later. The Dow is up 9.5, 9.75% since last August. S&P 500 is up about 13%, exactly as he had predicted. And then he said, but the downside. He said, is it worth the final 10, 15% when, in our view, is what he said, by our metrics, this stock market has to fall 50 to 70% to get back to where it can grow organically in a normal way that's connected to the real economy. So let's hard stop there. Let's now move on to another smart guy, Warren Buffett. And you've heard Walt talk about the Buffett Indicator. Well, what is this thing? Here's what Warren does. He's what, 93 years old? he's got a spreadsheet, and he's got all these stocks down the left side of the page, from the biggest, Walmart, Amazon, all the way down to the little guys. And then the next line over, how many shares of Walmart are there? Okay, we know that. What's the price per share? We know that. Number of shares times the price is a value on Walmart stock. Then he does it for Amazon. Then he does it at Microsoft, on down the line. Boop, boop, boop. Bottom left-hand corner, right-hand corner, sum total, enter. He values the stock market. And he says, all right, let's compare the value of the stock market versus the value of the gross domestic product, the economy. The historical percentage is the stock market historically is about 60 to 70% the value of the GDP. Where are we now? Here's this chart. This one goes back to, let me check, I think it's 1950. And where are we? We are 2 standard deviations above the norm. The stock market is now 200%, actually more, of the gross domestic product. We haven't seen a stock market like this in probably since 1929, not even .com did we exceed this level of Main Street being disconnected from Wall Street. Wall Street way up here, Main Street down here. So Buffett's indicator would say something's got to give. The economy must zoom up, or this market's got to come down to where we get some equilibrium, which is basically what Hussman is saying. And I'll do one more. Remember, Wall Street's not an investment organization. Wall Street is a sales organization. Wall Street is never going to tell you to get out. That's not what they do. And so they try to figure out ways to sell it to you that it's not as bad as these guys say. So how do you value a market? Well, one of the easier ways, gone back for decades, is price to earnings. How much money is a company making? What's their profit? And what are you as an investor willing to pay for the profits of the company? That's called the PE ratio, price to earnings. How much money are they making? Well, back 25 years ago, we started to see some changes, actually, even before that. Price to sales. How much is a company selling? Well, you ought to buy because look at their sales. Well, how much money are they making on there? Well, don't ask that question. Just how much are they selling? Back during the dot-com era, get this, Wall Street was trying to sell us on price per, this is no joke, price per eyeballs. Remember, it was .com. How many people were clicking on your .com site, and the number of people, eyeballs looking at it would translate to sales, and the sales would eventually transfer to profits. Well, how did that work out? Oh, the NASDAQ fell 80% and people got wiped out. Look at this chart, price to sales. You see the first big little mountain there? That's .com. We're here. We have exceeded .com levels on price per sales. I think what's driving this? Oh, probably AI. AI is probably selling some stuff, but is AI making much money yet? No. Is AI going to change the world? Yes, Walt and I know this, just like .com changed the world. But the stock and the company are different things. You want to be in companies that make money and not just selling eyeballs or this many mega whatever of information. You get the idea. So for my stock jocks out there, please be careful. It's a fragile market. Listen to the old timers. I wish I had listened to the old timers back in the day during .com, but I was young and arrogant. You guys just don't understand. The world is changing. We're the young. Yeah. Don't fall into that trap. So anyway, maybe next week we'll talk about what happens when markets fall, what happens to your portfolios, because clearly we're not in mainstream stocks over here. And I'm talking too much right now. So I'll turn it over to Walt and we'll pick it up again next week.